At a backyard barbecue last summer, Ryan spent 20 minutes telling everyone about his rental property. The tenant, the rent check, the equity, the way he drove past the house and felt something click into place in his chest. A few feet away, Priya stood by the cooler and said almost nothing, because when someone asked what she was doing with her money, the honest answer was index funds, and nobody wants a follow-up question about index funds. Ryan left that barbecue feeling like a genius. Priya left it feeling a little boring. And here's the part that should genuinely surprise you. 20 years later, when you actually run every real number for both of them, the gap between the exciting choice and the boring choice is nowhere near what either of them expected. And the reason has almost nothing to do with which asset class is better.
My name is John, and I spend way too much time thinking about the difference between what an investment feels like while you're making it and what it actually returns once every real cost gets counted. If you've ever wondered whether real estate or the stock market is the smarter place to put your money, stick around, because today we're going to run this comparison properly with every hidden cost included, not just the number that sounds good at a barbecue. Quick disclaimer, I'm not a financial advisor. This isn't financial advice, just the actual math laid out so you can see what's really happening underneath both of these choices. Here's the thesis this whole video is built on. Real estate and stocks were never actually competing for the same thing. One trades your time and your comfort for leverage. The other trades your patience for compounding. And the question that actually determines your outcome was never which asset class wins on paper. It's which one you'll actually stay with, honestly, for 20 uninterrupted years. Keep that in mind, because I'm going to come back to it at the end, and it changes everything about how you should read the numbers I'm about to walk you through. Shift number one is what the first year actually looks like for each of them. And it's not close, at least emotionally. Ryan has a physical asset. He can drive past it, he's dealing with tenants, fixing a garbage disposal in month 3, learning what a security deposit dispute feels like in month 7. And by December, he's claiming mortgage interest and depreciation on his taxes, which shaves a couple $1,000s off what he owes. Priya logs into her brokerage account maybe 4 times that entire year. Her $60,000 becomes roughly $65,000 by December, mostly because the market had a decent year. There's no tenant, no garbage disposal, no story to tell, just a number that moved slightly. If you'd asked either of them who made the smarter choice at the 1-year mark, Ryan wins that conversation completely, and it isn't close. Shift number 2 is where the real cost of real estate quietly starts showing up, the part that never makes it into the barbecue story. By year 3, Ryan has collected close to $75,600 in rent. Sounds fantastic, until you start subtracting. His mortgage payments over that period total around $57,600. Property taxes and insurance eat another $10,000 combined. He's replaced a water heater for $1,100, patched a section of roof for $2,200, and eaten 1 month of vacancy between tenants that cost him $2,100 in lost rent, plus cleaning and relisting fees. He manages the property himself to save money, which means his phone rings during dinner, and a Saturday morning every few months disappears into a hardware store run. After everything real is subtracted, his actual net cash flow over those 3 years lands somewhere between $2,500 and $4,500. Not the roughly $18,000 that looked so clean on his very first calculation. And that number still doesn't account for a single hour of his own time. Priya, meanwhile, has put in her original $60,000 plus $14,400 in contributions, and at a roughly 8% average annual return, her account sits around $84,000. 0 phone calls, 0 emergencies, 0 Saturday mornings lost. Shift number 3 is the one variable real estate has that stocks simply cannot replicate. And it's important to be fair about this, because it's the entire reason real estate creates so much wealth for so many people. Leverage. Ryan used $60,000 to control a $300,000 asset, Priya used $60,000 to control $60,000 worth of stock. That's a 5-to-1 advantage for Ryan the moment the property appreciates even modestly, because he's earning appreciation on the bank's money, not just his own. If that duplex appreciates a modest 3% a year, the dollar gain on the full $300,000 value dwarfs a 3% gain on Priya's much smaller principal, at least in the early years before her compounding really accelerates. This is the honest, real advantage of real estate, and anyone telling you leverage doesn't matter is leaving out half the picture on purpose. Shift number 4 is the part almost nobody actually budgets for correctly, and it's the reason so many landlords quietly underperform their own napkin math for years without noticing. The general rule of thumb for annual maintenance is 1 to 2% of a property's value, which on a $300,000 duplex is $3,000 to $6,000 a year, and that's before anything unexpected. Roofs last roughly 20 to 25 years. Water heaters last 10 to 12. HVAC systems last 15 to 20. These aren't maybes. They're guaranteed future expenses arriving in chunks of $5,000 to $15,000 whenever their time comes due, usually in whatever month is least convenient. If Ryan hires a property manager instead of doing it himself, that's another 8 to 10% of monthly rent gone immediately, somewhere around $170 to $210 a month. And then there's the risk nobody wants to talk about at the barbecue, a tenant who stops paying and knows how slow eviction can be, which can erase 3 to 6 months of rent plus legal costs in a single bad stretch. None of this shows up in the exciting version of the story. All of it shows up, eventually, in the actual return.
While we're talking about running real numbers instead of napkin math, I put together a community where I walk through exactly how I model out decisions like this one, real estate versus index funds versus a mix of both, using someone's actual numbers instead of generic assumptions. If that's useful to you, the link's in the description. No pressure, just there if you want it.
Shift number 5 is where the story starts to separate in a way most people never sit down and actually calculate. By year 10, Ryan's duplex has appreciated to somewhere around $400,000 to $420,000. His remaining mortgage balance is roughly $205,000, which puts his equity at approximately $195,000 to $215,000. Over that decade, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, and the capital expenditures that inevitably came due, his total out-of-pocket spending beyond the original down payment lands somewhere between $25,000 and $40,000. Priya's portfolio, with her steady $400 monthly contribution and that same roughly 8% average return, is sitting around $195,000 to $210,000. She put in $60,000 up front, plus $48,000 in contributions, $108,000 total. The rest is pure compound growth, and she spent exactly 0 weekends fixing anything. At the 10-year mark, they're remarkably close in total wealth. Ryan is slightly ahead, mostly thanks to leverage, but he's also put in hundreds of hours of unpaid labor, taken on hundreds of thousands of dollars in debt, and concentrated his entire investment in a single property in a single zip code. Priya is spread across thousands of companies and hasn't lost a single night of sleep over any of them.
Shift number 6 is where compounding finally does what compounding is supposed to do, and it's the part that makes the entire back half of this comparison so different from the front half. By year 20, Ryan's duplex is worth somewhere between $500,000 and $550,000. His mortgage is paid off or very close to it. His equity sits somewhere between $460,000 and $520,000, depending on how the local market behaved. After 2 decades of maintenance, turnover, taxes, insurance, and at least one major renovation nobody saw coming, his total net profit from actual cash flow on top of that equity is probably somewhere between $45,000 and $85,000.
Priya's portfolio, still receiving that same $400 a month at roughly 8% average annual return, has grown to somewhere between $450,000 and $500,000. Her total contributions over 20 years come to $156,000. Everything else, well over $300,000, is compounding that happened while she did nothing at all. When you place their net worth numbers side by side at the 20-year mark, they land in almost exactly the same range, somewhere between $450,000 and $520,000 each. But how they got there could not look more different. Ryan worked for his number. Priya waited for hers.
Shift number 7 is the part that actually changes the entire comparison. And it's something almost nobody mentions when they're arguing real estate versus stocks online. If Priya had simply increased her monthly contribution by $200, bringing it to $600 a month, her 20-year total jumps to somewhere between $620,000 and $680,000, comfortably ahead of Ryan's outcome, without buying a second property, without taking on another mortgage, without a single additional Saturday lost to a hardware store. In the stock market, scaling up your investment is usually just a decision. In real estate, scaling up almost always means acquiring an entirely new asset with its own down payment, its own mortgage, and its own maintenance schedule. That asymmetry, how easy it is to increase your contribution in one path versus the other, matters more over 20 years than almost anything else in this entire comparison.
Shift number 8 is about being fair to the risks on Priya's side too. Because if I only showed you the downsides of real estate, I'd be just as dishonest as the people who only show you the upsides. Stock market volatility is genuinely brutal at times. Markets have dropped over 30% within a matter of weeks during real historical crashes. And if Priya had watched her balance fall by a third overnight, that's not an abstract number. That's a gut punch. Index funds also don't send you a monthly check the way a rental does. Dividend yields on a total market fund typically run somewhere around 1.5 to 2%, which on a $200,000 portfolio is roughly $300 a month, nowhere near enough to replace anyone's income. And Priya gets none of the leverage or the depreciation tax benefits that quietly boost Ryan's real returns every single year. Real estate genuinely has structural advantages that stocks cannot replicate, and pretending otherwise would be its own kind of dishonesty. Shift number 9 is where real estate actually does clearly win, and it's worth naming specifically instead of pretending the answer is always "it depends" without elaborating. If you're buying in a market where monthly rent is close to 1% of the purchase price, the cash flow math works in your favor from day one instead of fighting you for a decade. If you're willing to treat it like an actual business, screening tenants carefully, budgeting for capital expenditures in advance, and building real systems instead of winging it, the returns can meaningfully outpace stocks, especially with leverage compounding in your favor. If you house hack, living in one unit while renting out the others, you can reduce your own housing cost close to zero while equity builds in the background, something the stock market simply has no equivalent for. And strategies like a 1031 exchange let real estate investors defer capital gains taxes indefinitely by rolling profits into a new property, a tax advantage stock investors don't get outside of retirement accounts.
Shift number 10, right before we get to the real answer, is about something that rarely gets discussed honestly, which is what illiquidity actually does to Ryan's behavior compared to what liquidity does to Priya's. Ryan cannot log into an app at midnight and sell his duplex because he had a bad week. That friction, the fact that real estate takes months to sell, paperwork to file, and a buyer to find, accidentally protects him from his own worst impulses. Priya can sell her entire portfolio in about 4 seconds from her phone, which means every single market downturn is a fresh temptation to lock in a loss she never needed to take. The data on this is consistent and a little depressing. A large share of retail investors underperform the very index funds they're invested in, purely because they buy high out of excitement and sell low out of fear, not because the fund itself performed badly.
Ryan's illiquidity is annoying when he wants to move cities. It's also the exact mechanism that forced him to stay invested through every downturn without ever having the option to panic. Priya's flexibility is genuinely valuable, but it only pays off if she has the discipline to almost never use it. And that discipline is a skill most people significantly overestimate in themselves until they're staring at a portfolio that's down 30% in real time.
Shift number 11 is the question of what either of them gives up along the way that never shows up in a net worth spreadsheet. Ryan gave up a meaningful chunk of his free time for 2 decades. Evenings answering tenant messages, weekends coordinating repairs, vacations mentally interrupted by a text about a leaking pipe. That time has a real value, even if it never appears as a line item. And depending on how you value your own hours, it can quietly erase a significant portion of whatever advantage his leverage produced. Priya gave up almost none of her time, but she gave up the tangible feeling of ownership, the thing Ryan got to describe at every single barbecue for 20 straight years, while she quietly said index funds and watched people's eyes glaze over. Net worth spreadsheets don't have a column for boredom or a column for stress, but both of those things were real costs paid by real people, and pretending otherwise makes this comparison less honest, not more.
Shift number 12 is the option most people skip past entirely because it doesn't make for a clean headline, which is doing both instead of picking a side. Plenty of people who build serious long-term wealth aren't exclusively landlords or exclusively index fund investors. They're people who put enough into the market to let compounding run in the background on autopilot and then use whatever's left, along with actual patience for the right deal, to pick up a single well-vetted property instead of 3 mediocre ones. The false choice between real estate people and stock market people mostly exists because it makes for a punchier YouTube title than it depends on your specific numbers. But the honest version of wealth building for most people who succeed at either path usually involves some blend of the two, weighted toward whichever one matches their actual tolerance for debt, tenants, and time spent on a Saturday.
Shift number 13, the one I promised to come back to, is the actual answer underneath this entire comparison. Ryan and Priya both walked away from that barbecue believing they'd made the smarter move. Ryan thought real estate was the proven path. Priya assumed the market would quietly do the work for her. Neither of them sat down and mapped out what their choice would actually cost in dollars, in time, in stress, and in risk before making it. And 20 years later, their net worth ended up almost identical anyway. That's the part that should reframe how you think about this entire debate. The real trap was never picking real estate or picking stocks. The real trap is choosing either one based on a podcast clip, a barbecue story, or something your uncle said with total confidence, without ever running the actual numbers for your own specific situation, your own market, and your own tolerance for either debt or volatility. Both paths can build the same few $100,000 over 20 years. The only thing that actually separates people isn't the asset they picked. It's whether they stayed with it honestly and consistently for the entire 20 years, without panic selling, without over-leveraging, and without quitting somewhere around year 6 when it still felt boring or overwhelming.
So the next time somebody tells you real estate always wins, or the stock market always wins, ask them one question before you believe either version. Did you include everything? Because the version of the story that survives that question, mortgage interest, vacancy, maintenance, taxes, volatility, and 20 years of actually staying invested, is the only version that was ever telling you the truth. Just a reminder, I'm not a financial advisor, and this video is for educational purposes only. Any results depend on your own decisions and your own market. I'll see you in the next one.